Left in 2013, and as we prepare to ring in the new year, we'll also be saying goodbye to some popular tax breaks. We're here to tell you which deductions you should take advantage of before they expire. As the director of the American Institute of CPAs, Melissa Labonte. Melissa, thanks for joining us this morning.
Good morning, Clayton. How are you?
I'm doing well, and these things to take stock of here before the end of the year. Let's dive right into them and some of these expiring exemptions. State sales tax deductions. Explain this one.
Yes, if you itemize your deductions as opposed to taking the standard deduction, you generally have the option of either deducting state sales taxes or state income taxes. That option to deduct state sales taxes is going to expire here in just a few days. This is going to be...
I'm sorry, go ahead, Melissa.
I was going to say this is going to be particularly troublesome for those people that live in states with no income taxes, such as Florida, Texas, and Washington State.
Troubling for them. And we saw a story this morning about Florida's population about to beat New York, so that could be a problem. All right, let's talk about education expense deductions. A lot of people rely on this. What two things are about to happen here?
Well, first we have an out-of-pocket expense deduction for teachers, principals, and aides for anywhere from kindergarten to 12th grade, and that's up to $250. And also on the student side, for college tuition and fees for those students, and I say students, but typically it is the parents who get those deductions, and that amounts up to $4,000 for most middle-income tax families.
All right, let's talk about energy-efficient deductions. A lot of people with the solar and green energy programs, are those expiring?
Well, the most popular provision is a 10% tax credit for some energy-efficient improvements to your home, such as insulation, doors, and windows. So let's say you spend $2,000 in windows, you're eligible for a credit of up to $200.
So check and see what deductions are vanishing this year. Mortgage deductions, this is a big one. A lot of changes here. Explain.
Well, there are two provisions that taxpayers should be aware of. First, if you didn't quite have enough money for your down payment and your lender required you to get insurance called PMI, in the past, you've been able to deduct that amount, those premiums, just like you can mortgage interest. Unfortunately, that's going to be going away in just a few days here.
I'm sorry, go ahead.
Also something you should be aware of, if you're having financial difficulties and there's a chance you're going to lose your home next year, you know, from a foreclosure or short sale, you should be aware that you may have to pick up something in income. Let me give you an example, because it's not very intuitive. If you have a house that's worth $180,000, and let's say it's underwater, so your mortgage is $200,000, and the bank erases that debt and lets you walk away, walk away clear, you could have to pick up $20,000 in income.
What about quickly distributions to charity with your IRA?
Yes, this is a popular provision for taxpayers age 7.5 or older that are required to take distributions from their IRAs. Generally, those distributions are taxable. But the last couple of years, Congress has allowed a provision that you can take the money directly from your IRA and contribute it to charity, and you don't have to pick up that amount in income. So it's great for those seniors that would not otherwise get any type of a tax break for those charitable contributions.
Big changes coming to our tax code in 2014. Melissa, thank you so much for joining us this morning. We appreciate it.
Happy to be here, Clayton.